As of December 31st, 2020, Timberline Corporation is having its financial statements audited for the first time ever. The auditor has found the following items that might have an effect on previous years. Timberline purchased equipment on January 2nd, 2017 for $130,000. At that time, the equipment had an estimated useful life of 10 years with $10,000 residual value. The equipment is depreciated on a straight line basis. On January 2nd, 2020, as a result of additional information, the company determined that the equipment had a total useful life of 7 years with a $6,000 residual value. During 2020, Timberline changed from the double declining balance method for its building to the straight line method because the company thinks the straight line method now more closely follows the benefits received from using the assets. The current year depreciation was calculated using the new method following straight line depreciation. In case the following information was needed, the auditor provided calculations that present depreciation on both bases. The building had originally cost $1.2 million when purchased at the beginning of 2018 and has a residual value of $120,000. It is depreciated over 20 years. The original estimates of useful life and residual value are still accurate. Number 4, Timberline purchased a machine on July 1st, 2017 at a cost of $160,000. The machine now has a residual value of $16,000 and a useful life of 8 years. Timberline's bookkeeper recorded straight line depreciation during each year, but failed to consider the residual value. And 5, prior to 2020, development costs were expensed immediately because they were immaterial. Due to an increase in development phase projects, development costs have now become material, and management has decided to capitalize and depreciate them over 3 years. The development costs meet 6 conditions for capitalization of development phase costs. Amounts to expense were as follows. And we're asked to prepare the necessary journal entries to record each of the changes or errors. The books for 2020 have been adjusted but not closed. Ignore income tax effects and round to the nearest dollar. Okay, so what we have here is, let's see what we've got. So we've got a couple things going on. So what we need to do is figure out which of these things are going to be errors and are going to require retrospective restatement and which of them are not. So let's take a look. So for one, we changed the estimates around the useful life and the residual value of the equipment. So this is a change in estimate. And it's going to be prospective. Number 2 is going to be another change in estimate. And so for number 1, there's no journal entry required because it says that the 2020 books have already been adjusted. So because the change is going to be made at the beginning of the year, 2020 is already correct. So there's no retrospective change to be made because this is going to be accounted for prospectively. Same thing for number 2, no journal entries required. And number 3, which is the machinery. So the machinery, Timberline's bookkeeper failed to recorded straight line depreciation, but failed to consider the residual value. Well, this is an accounting error because the residual value should have been applied. So this is going to need to be retrospective. So what journal entry are we going to have here? Well, we're going to have, okay, so the machinery, so July 1st, 2017 to December 31st, 2020, which is the current year. So we're going to have 3.5 years from the purchase date to current. So from July 1st, 2017 to December 31st, 2020 is 3.5 years. So then we are going to say, okay, so what's the depreciation? So we've got 160,000 divided by 8. So that's 20,000 without the residual value. That's how the bookkeeper was accounting for it. So because they recognize this for 3.5 years, they're going to have this times 3.5. So they would have recognized 70,000 of depreciation. So that's going to be our accumulated depreciation. And so that's our cumulative depreciation. And what should have been recorded is the 160,000 minus, 160,000 minus the residual value. So here I'm going to take 160 and I'm going to subtract off the residual value, which is 8 years, and then divide it by, the residual value is 160, the residual value is 16,000. Now I'm going to divide it by 8. And that's what the depreciation should have been. So it should have been 18,000, not 20,000. So 18,000 times 3.5 is going to be 63,000. So the difference between what was recorded and what should have been recorded since the purchase of the equipment is that it's been over depreciated by 7,000. So that means our adjusting entry is going to be debit accumulated depreciation, because we're going to decrease the accumulated depreciation by 7,000. We are going to credit retained earnings. We're going to increase our retained earnings because our depreciation is lower by 7,000, actually by, oh, and sorry, 1 year of this is current because remember there's one current year in here. So we're actually only correcting. So 3.5. So if I change this to 2.5, that's going to be my past error. So my past error then is going to be, what happened here? So my current depreciation is going to be debit depreciation expense for 2020. It's going to be 7,000. No, it's going to be 2,000. So then, because what's this? Okay, and then retained earnings is going to be the difference between the two, so it's going to be 5,000. Okay, so that takes us through that entry. Now let's do, okay, so what else do we have? And that's because we have some additional information here as well. So next we've got, they purchased a machine. The machine had a residual value. Oh, we did that one already. Then this one is prior to the development costs were expensed immediately. So this is also a change in estimate, which is prospective, number 5, because these costs were previously immaterial. So this is the adoption of a new policy. It's actually not even a change in policy. This is an adoption of a new policy. So prepare the journal entries. So no journal entries for anything except for this one here for the accounting error. Calculate the 2020 depreciation expense on the equipment. We just did that. Calculate the comparative net income amounts for 2019 and 2020, starting with income before the effects of any changes. Income before depreciation expense was 600,000 and 420,000 in 2019. Okay, so let's see what we've got here. So we've got, so we're going to have, okay, so we're going to have income before depreciation and before impacts of changes. So we're going to have here, we're going to have 2020 and 2019. So we're told that this income was 600,000 and that this income was 420,000. Whoops. Now we're going to have the depreciation of the equipment. Sorry, depreciation of the equipment. Depreciation of the building. Depreciation of the machine. And development costs. So what is the impact of all these changes prospectively? So in 2020, so depreciation on the equipment, it's going to be, actually we didn't quite finish this. This is just the retroactive piece. So the calculation of 2020 depreciation expense is going to be, so the cost of the equipment is 130,000. So the first one here, so this is for A. So the cost of the equipment, so let's just do some side calculations here. So this is going to be A. So the equipment, item 1. So the cost is 130,000. And what else do we have? The cost here, at that time, the equipment had an estimated useful life of 10 years with a $10,000 residual value. And then we changed it. So it would have been, so what was the amortization? Because we need to know the net book value so we can calculate the 2020 depreciation. So it's going to be 130 minus 10 divided by 10 for 3 years. So because we're going to have January 2017, 2018, and 2019 because we're in 2020 now. Okay, so we're going to have depreciation is going to equal 130,000, which is the purchase price, minus the residual value of 10,000 that they were using before, divided by 10 years. So it's going to be $12,000 per year, old method. And this was for 3 years. 3 years. So that means that 2017, 2018, and 2019, we calculated 36,000 of depreciation. So the net book value is going to be 130 minus 36. So this is the net book value January 1st, 2020. And now we're going to recalculate the depreciation. So we're going to take this amount, we're going to subtract the residual value, the new residual value, and we're told in number 1 that the residual value is now going to be 7 years and $6,000. Okay, so 6,000 divided by, and don't forget now, it's 7 years, but how many years have passed? Well, 3 years have already passed, so 7 minus 3 is 4, divided by 4 years. So that's going to give me $22,000 of depreciation expense. And that's the amount that I'm going to put into my comparative schedule here is minus 22,000. And it's going to be for 2019, which was the year prior. How much should we have? We had 12,000. Remember right here, we calculated the per year old method. You can see the comparative there. Okay, so depreciation of the building, and we have some information up here on that. So depreciation of the building is going to be double declining method for the building to the straight line method. So we're going to have, so the cost of the building, let's just put this here, cost of the building is going to be 1.2 million. Okay. And then what's the accumulated depreciation? The accumulated depreciation is going to be because the company thinks the straight line method, the current year depreciation was calculated using the new method. Residual value of 120,000. Okay, so we're told that we're given some information here. So we're given some more information here. I think this 3 is actually just an error, so disregard that. So we're told that the double declining balance amortization each year was 120 in 2018 and 108 in 2019. So we're going to take those amounts off to figure out the net book value. 120 and 180. So that's going to give me 120 and 108, sorry. Okay, so 972,000, this is our net book value, January 1st. Then we're gonna say, okay, so then what we're gonna do is recalculate the 2020 depreciation. So we're gonna take this amount, we're gonna take off the residual value. So it says residual value is 120,000. And we're gonna divide it by 20 years. So the depreciation should be, actually, we aren't going to divide it by 20 years because some of this time has already passed. So how much time has been passed since we purchased this building? 2 years has passed because we purchased the building in 2018 and it's now 2020. So that's a perfect example of where you have to be really careful with the denominator. So the depreciation should be 47.33 per year. And that's the number that I'm going to put down here into my schedule. So I'm going to have depreciation on the building, 47.33. Whoops. I missed a 3 there, 47.333. And in the prior year, we had the depreciation as given in the table of 108. See in this table right here, it's giving us the depreciation under the double declining balance. So depreciation of the machine. So let's take a look at that one. So Timberline purchased a machine on July 1st, 2017 at a cost of 160,000. Machine, so the cost is 160,000. And useful life of 8 years, residual of 16. The Timberline's bookkeeper recorded straight line depreciation, but failed to consider the residual value. So what she did was she took 16,000 and divided it by 8. So she got 60,000, old method error. Okay. And what should have happened is we should have taken 160,000 and subtracted off, which I believe is 16,000. We can double check that as the residual, and then divided it by useful life of 8 years, but the remaining useful life. So we're going to take off the 16,000 and the remaining useful life is going to be, so this was 2017. So it's going to be 3.5. So 8 minus 3.5 is going to be 4.5. Okay. 8 minus 3.5. Okay, so for the machine, actually, we had already done the math up here where we had calculated the retained earnings impact. So because of that, we've already corrected the machine value, so we can include the minus 18 in each year. Okay, so then next we've got development costs. So prior to 2020, development costs were expensed immediately. The development costs meet all criteria. Amount expensed in 2017, 2018, and 2019 were 300, 500, and 1,000. During 2020, 4,500 was spent and the amount was debited to deferred development costs. Okay, well, 2020 is going to be then, it's going to be $4,500 was spent and the amount was debited to deferred development costs and asset account. So then we are going to put the net of the amount that was debited with the amount that is going to be corrected from recosting those other amounts. So we are going to put, because we can move it, because it's just a reclassification. So we're going to have here, we're going to have 4,500 minus 300 minus 500 minus 1,000. Okay. So this amount is going to be 1,800 or 1,500. Because it's depreciated over 3 years. So 4,500 divided by 3 years gives us 1,500 of depreciation, which we are going to subtract here. And there was nothing here because we were expensing the cost, which was fine. Okay, so now let's put our net income down here. And let's sum these up. So we've got our net income. We've got 511,000 and 282,000. And that takes us through the conclusion of this question.